Hey there, traders. We're back for two daily recaps, one for Thursday, February 27, and one for yesterday, Friday, February 28. I didn't make the videos the last 2 days. Thought it'd be better just to do it today. This is Saturday, March 1st, so I can spend more time and do it justice. So first, we're talking about Thursday, which is the down candle here, this red down candle. On Thursday morning, before the opening bell, it was said in the game plan that if the bears could keep price under these trend lines, then they would have an easier time driving price down, and it could be overall weak for the day. And it was, although during the drop down, there were some levels that received some attention with some bounces, a few trades. We'll go over that, of course, in detail on the 1-minute chart. But just to bring your attention back to this breakdown candle back on the 21st. So at the time, price was above this trend line here. So they could easily have climbed this daily breakdown candle, found some resistance higher up, maybe attempted the highs again before they fell, because that would provide more resistance depending on the timing of it, or they could just go lower from there. Well, they did. In fact, the very next day, they closed below the low of that breakdown candle and below this upper trend line. And of course, you see what they're doing here. It wasn't too surprising that once they got under these trend lines for several days, that there would be pronounced weakness, and that's what happened on Thursday. So here we have the game plan Thursday morning before the opening bell. You can see the time. And essentially, it's this statement here we want to focus on. If the bulls could get above that whole area, the zone, 600 was above that, then they could put up a fight. But if the bears succeed in keeping price down below those trend lines, better chance for overall weakness throughout the day, which is what happened. And you can read the rest of this and a screenshot of what everything looked like before the opening bell. And here's Thursday's activity on the 1-minute chart between the vertical lines. They opened right below the trend lines. They went up pretty early on, hit them. Obviously, that was where the overhead resistance was, and they fell for pretty much the entire day. On the way down, where were the trades? Because, well, you could have taken a trade here. It's before 9:45. It's before that 15-minute window. I actually did. You'll see me take like 6 points here because I had some things going on. I didn't have a whole lot of time to trade later in the day, so I wanted to get some trades early in the day. So I took a chance, paid off. But anyway, after 9:45, where were they? They were down here, and perfect place to go short if they came back up into this level. Market's telling you that this level, once they get under it and you're at the 15-minute window, it's a better chance they're going to continue to go lower. So going short at the level gave you at least 4 points, quite a bit more actually. Took another trade once they got under this level and rode this down a little bit. We'll zoom in here at this level at 593.15. You would have gone long at 593.20. So we're going to adjust this 5 cents toward price. This helps in several ways. So what you're looking for, of course, if you bought at the level, 593.20, that's the operating level, then you want to bounce of 40 cents, and that would be 4 points in the E-minis, 593.60. However, they got down to 593.25. That's 5 pennies before they bounced. They bounced enough for a base hit without you being in the trade because they came up short. So that is a near miss. Market's telling you probably not good to trust this level. It doesn't look like much here, but when you have big swings and volatility is picked up, that little bit right there is a 4-point base hit. So you leave it alone. Don't trade this level. They got under it. Eventually, they came back up. But had you gone long here, you would have been in trouble because the timing would not have worked out. You would have had to make the decision to jump out or reverse. So safe thing to do was just pay attention to this clue here, this near miss, which is if price in the SPY gets within 10 cents of your operating level and then bounces or pulls away 40 cents or more, then consider that the trade. If you're strictly playing by the rules, you would ignore it. No trade there on the long side. Not enough time passed from when they got under this level to where they're back up to it here for you to take a recycle trade, which means go short here. Although just glancing at it, it would have worked. We're not going to count this because of the timing component, but they're up to 595.90. We went short here, got the base hit. I only like to trade the level one time, so I wouldn't have done it myself, but there's 2 more chances of that level. That was the long trade that didn't happen there. So while they bounced pretty cleanly here, they got down to 593.22, so 2 pennies above the level here. So still a near miss type of thing. So nothing here until they're down to this level at 589.97, which becomes 590.02. And they did the same thing. You want them to hit 590.02 in the SPY, at which point you would buy at the market in the E-minis, wherever the equivalent in the E-minis is. But they came up within 5 cents, 590.07, and pulled away. 590.42 would have been the equivalent of 4 points in the E-minis, and they came up to 590.39. So once again, near miss, don't trust the level. In this case, it would have saved you a lot of trouble because they never got above this level again for the rest of the day. However, when they got down to 586.80, which is 586.85 to trigger the trade, they bounced very quickly, gave you your 4 points, a few more points if you wanted to hold out more than once, and then got below and kept going. And this, by the way, happened right before our cutoff, 3:30 p.m. or within 30 minutes of the closing bell. We're not going to take any trades. So this was 3:15 p.m. So really just two base hits, one up here, one down here. And if you chose to give price a little more wiggle room, you could have traded some of these other ones, but strictly playing by the rules, it would have kept you out of trouble in more than one situation. Before we go over to the tracking logs to see how Thursday played out in terms of dollars, let's look at the two trades that I took. I mentioned that I went short at the trend lines, a quick 6 points with two contracts, $600. And they got down here to 595.90. I kind of ignored this one. I just wanted to see what they would do with it. And once it became obvious that they were weak and they were going to go lower, I went short. I jumped on board and got, I think, another 8 contracts pretty quickly. I had a meeting at 10 o'clock, so I wanted to kind of get out of that trade. So instead of holding out for, what was this, 13 points, I got 8 points. And once that was done, that was it for me. Everything has been made dotted. I'm not going to trade anything for the rest of the day. That was a pretty good $1,400 or so. And I let this thing go and recorded it for a few more hours, just so you can see. Stop this. What time was it? Right before 2 o'clock or so. Packed up. Here are the tracking logs for Thursday. Playing by the rules. You can read the notes here, starting at level 4 on the way down, and the 2 base hits that resulted if you were strictly sticking to this process. And there's where you would have landed. Once again, we're assuming 2 ES contracts traded at every level since the beginning of January, and here's where we're at. Over here on the Sam's Trades log, here are my 2 trades. Totaled 14 points. You can read one was 6, one was 8, both with 2 contracts. So $1,400 before commissions. Now let's look at Friday. Friday was the up candle. How could we have known that this was an area that the bulls could come in and push price back up? I said so in the game plan, which we'll look at shortly. Here is one clue. See where they went down to on Thursday. I'm just going to put a line at the low of Thursday. So visualize what price is doing back in time when they got up to this same area here. Back in whenever this was, October, they got to this general area, couldn't get above it for quite a while. This is a lot of days. They gapped above this area, came back down. It provided support. Not too surprising. It's a breakout area. And they did this several times. This whole area is kind of important. Well, they're coming back into this area again. And by the way, there's a gap that wasn't filled. This is the close of this day, whatever it was, January 14. Let's go ahead and put a line on the close there. So now we're at the close of Thursday. Friday's opening. This general area is going to be support, most likely. And what did? They came down, almost filled this gap, and went up for the rest of the day. And as you might have guessed, that scenario was spelled out, most of it was, in the game plan for Friday, which looks like this. Feel free to read this. So yesterday's drop ended and closed at an area the bulls are likely to come in and defend. It's an important area. Price can bounce in a bigger way. Timing component is on the bull side. I did not mention that earlier. The fact that they've been going down a certain amount of time, certain amount of days. Speculation here, but I can visualize a big up day if the bulls get the ball and run with it, which is the higher probability. Of course, the other side of the picture is they could go lower or they can go sideways. Got to consider everything. You can read through this if you want. But that was what I was betting on, and it worked out pretty well. And we can take a look at the trades in the 1-minute chart and how you would have traded Friday based on the levels we had from Friday morning before the opening bell. So on Friday, price opened above this level here at 584.68. They got below it. They bounced a little bit, but they got below it and got above it. So where were they at the 9:45 or the 15-minute window? They were above. So pretty good sign, along with everything else we talked about, that the bulls probably are going to drive price up. So anyway, 9:45, they were up here, going long at 584.73, would be 5 cents above the operating level. And they came down, hit it to the penny, 584.73. That would have triggered your long trade in the E-minis, bounce from there, grab 4 points or more. They came down to this level again. You're not going to take another long trade. Let's look at the original level, 584.68, and see when they got underneath it. So they get under right here. If you want to take a short trade for what I call a recycle trade, then 584.68 becomes 584.63, or moving up 5 cents toward price. They came up short here. There's a near miss. Still not enough time. There's enough time overall where you could have gone short here. So I'm going to explain a couple things. Considering you saw this near miss here, pull away, they came up short of this 582.15. Not a near miss. They came 20 or 30 cents or so away, but that looks pretty bullish. So considering what you know in the big picture about the possibility of them being bullish and pushing up for the day as a whole, would you want to go short here at 584.63? Well, the market was kind enough to give you one more clue that if you had gone short here, that this level might not have worked out so well, at least initially. And here's how. They went up, you would have triggered a trade, gone short at 584.63 or whatever the equivalent was in E-minis. They pulled down immediately within 1 minute, 30 seconds probably more likely, to a low of 584.29. You're within 10 cents. You could have had a 4-point base hit before they got back up to your entry point, give you a few chances to jump out. So that was your clue not to take this for a short trade, because for all you know at this point, once they got above this area, they're going to go higher. They did pull back, but we can't count this per the rules. And if you had been in a short trade, you would have gotten in trouble here because you would have hit a time component where you would have reversed, lost some money, and then gained some back. That never happened, so it's neither here nor there. But the point is, that was your clue to not go short at this level. So 1 base hit for the day, and it was over here. But in the big picture, you can see how this whole level, this whole area was important. It was the support the bulls needed, and they pushed price higher. So they did hit 591.80. Are we going to take a short trade here at 3:54 p.m., just 6 minutes before the close of the bell? No, we are not. With this type of momentum at the end of the day, your clues back here, since they came up short of this level here, it's kind of bullish. They had enough front runners down here to push price up, because all these levels are important in their own right. They got above this level. So once they got above here, started closing candles above, say in this area here, you had a clue if you wanted to. I'm not saying you should have. I certainly didn't do this. Just to jump on board and ride this thing up, because you have to consider the big picture, like the daily chart we looked at earlier. Where were they in the big picture is the question you want to ask yourself for these bigger type of moves. So here's the trade that I took on Friday. So notice the time. Someone had the audacity to pull me into a 9 o'clock meeting. So from 9 till almost 10, this thing was just running and recording. I didn't do anything, of course. I wasn't in front of the computer. Just wanted to have this data to share. So right before 10 a.m., I got back to the computer, saw what was happening, saw some bullish writing on the wall. So I jumped on board with one contract, really meant to be 2 contracts. I had a chance to add to that position later, you'll see. So right before 10, I get back to my computer, see what's going on. I buy one contract just kind of there, not really arbitrarily. I mean, I had reasons to do this because I would have gone long here anyway and try to ride this thing up more. And I added to this position, ended up being long 2. I'll just let this play. I'm not sure when it happened exactly. Gave them some time to kind of settle in and to establish some bullish dominance here, if you will. Maybe I should just move ahead in the interest of time. There we go. So when they pulled back this time, I bought 2, adjusted my profit target here to buy one or to sell one contract to get out of half of that position, and they gave it to me. And I put a trailer of maybe 15 points or so, and it pulled price up a little higher, but not a ton. Ended up being the equivalent of 15 points. There you go. So $500 as high as I got before it stopped me out. And once that happened, right here, that was it for me. Everything's done for the day as far as I'm concerned. And I took my 15 points and called it a day. After, what time was this? Right about lunchtime, I stopped this, and that was my trade on Friday. And how does that look on the tracking logs? Well, here's your one trade. If you were playing by the rules, you can read the notes and notice that we got through the first 2 months of 2025, and we're almost at 50% rate of return. Strictly playing by the rules. Let's just see how February did. So February was 26%. January was 23%. So far, we're at 49.55. So my trade for the day was just the one, which you saw, a net 15 points on 2 contracts, $1,500 before commissions. And you can see my rate of return for much less trades, a lot less trade days, and a lot less levels I've traded. But this works for me because I can get things done pretty quickly in the morning and not have to worry about the rest of the day. You can derive whatever meaning you want from these metrics. You see them happening every single day, even if you don't necessarily understand the nuances. The time is nearing where you will have the ability to learn everything, how to identify the levels and how to trade them, all the rules and everything else. So before we sign off, let's go back to this chart. Let's look at a weekly chart here. So we talked about the 20-period moving average. Well, they fought this. They got below it. They closed under it. So maybe that's kind of weak. We're not really sure at this point because there have been several times they've gotten under the 20-period. And by itself, the 20-period doesn't mean a whole lot. But clearly, it's been important lately. And remember, on the daily chart, they got down on Friday right here, right in front of this gap. So this gap has not been filled. Generally speaking, this is an area that price needs to get to satisfy an open gap or a close from a previous day. So what does this mean on the weekly chart? Well, they could try again next week, or they could fight above. And once again, they have to get above these trend lines. And it could be harder for them to do this as time goes on. There's going to be other levels of resistance for them to go higher in the bigger picture. And if we go to the monthly chart, since February closed, where are we? Well, pretty far extended above all the moving averages. And you know where they're at this point, right? Call it 610. That's the 100% Fibonacci extension, the symmetrical move from this low to this high, added to this low to this high. It's a good target. So they've been stalling out here for quite a while. This is the 4th month in a row they can't get above 610 in that area. I'll just show it to you so you know what I'm talking about. This low, this is a pretty important move to the high they made, down to this low, and there is the 100%. Can you see that? 609.83 is the exact number. That is essentially the exact number of points between these two moves. So what we have on the monthly chart is what could be a bullish consolidation. You have this relatively big up candle, a big up move here in November, and they're kind of within the body of this. They could come down toward the bottom of this, and that would give them the energy and the timing to bounce and go higher. Meanwhile, the 20-period moving average is catching up to price. Or if they get below this area here, the low of this breakup candle, which is around, well, exactly, the low is 567.89, so call it 568, and close a monthly candle or two below that, well, they might be headed down somewhere lower. And there's plenty of areas here where there could be some support to catch price, but they're in the middle of this. They got to get above these highs to go higher, and if they get below this low, like we just talked about, they could go lower. So a lot can happen in between this, and it could take many months for this to play out. No clear signals other than a little doji kind of tail candle we had here, but a pretty low volume for February. Will that mean anything? Remains to be seen. What it basically gave us is a high to trade against or to keep an eye on in the future if price gets up there. Essentially, it's a line in the sand in the big picture that the bulls need to be above for higher prices to come to fruition. So that's a wrap for February. On Monday, March 3rd, we'll do this again with new levels and a new game plan. Not going to make any promises just yet, but the course, which has been ready for several months, should be ready to launch and go live and be available if the e-commerce and the back end of the website, everything is tied in correctly. And a couple meetings I have next week with the web developer who I've hired to do this looks pretty promising. So we're getting close finally. Thanks for your patience on this. I know there's been some of you who have followed along for about a year now, and I appreciate it. And that has not gone unrecognized. I'm taking that into consideration in how I'm pricing the course and the daily levels. And there are other resources which I think you'll find very helpful. But anyway, that's all I'll say about it right now. Talk about this more next week, most likely. So thanks for watching. Hope you found some value. Consider subscribing if you haven't already. I will talk to you soon in the next video. Have a great day.